Hello viewers, so we are back with another video on managing your personal finance. Finance management is one of the most vital things in your life. Most people struggle to manage their finances properly. It is mainly due to their poor lifestyle choices and spending habits. Getting the fundamentals right makes managing finances easier. But before we start the discussion, please subscribe to our channel and keep on getting tips on such topics that would help you manage the finances. Now, let's talk about 5 personal finance mistakes to avoid. Here, we'll look at some of the most common financial mistakes that frequently lead to major financial difficulties. In case you are finding it difficult to manage your finance, then avoiding these mistakes would benefit you to the fullest. Spending more than your income. Spending more than your income will cause you to dislike your job because you will not earn enough to cover your expenses. As a result, individuals should always limit their expenses to less than what they earn. Your expenses should always be within your income, regardless of how much you earn. If it exceeds, you will be forced to take out credit. You must manage credit responsibly to avoid finding yourself in a debt trap that is difficult to escape. Not applying the 50-30-20 rule. Every person should have a budget in place. You should create a budget on a monthly basis and stick to it. Every individual should adhere to the 50-30-20 budgeting rule. Now let me explain what this rule is. You must devote 50% of your income to necessities like groceries, EMI, rent, utilities and so on. 30% to desires like gym membership, outings and so on. And the remaining 20% to savings. Now coming to the third point, not planning your taxes. Tax planning is an essential component of any financial plan. Otherwise, you will end up paying more taxes than you should. There are several deductions and exemptions in income taxes that you should know about. Planning your taxes at the start of the fiscal year is best because you never know what will happen at the last minute. Making no investments. It would be beneficial if you always make investments to have a better future. Some of your income should be invested in avenues that match your risk tolerance. In your early professional years, you should invest aggressively and reduce the risk you will take as you approach retirement. Now coming to the next point, not making retirement plans. Everyone must plan for the retirement. Why should you rely on others when you can be self-sufficient? Several plans allow people to set aside money for retirement regularly. The best way to plan your retirement is to invest in mutual funds, NPS, PPF and VPF. You will not feel the pinch because you set aside a small sum every month. To avoid the dangers of overspending, begin by tracking the small expenses that add up quickly, then progress to tracking the large expenses. Consider your options carefully prior to opting for new dates to your payment schedule, and remember that making a payment does not imply being able to afford the purchase. If you can avoid these common financial mistakes, you will be able to build your finances well to secure your future.